All right, let's get right into it. Today, we're going to break down one of the most important ideas in all of investing, how to actually protect your money. We're going to look at the core strategies the pros use, not just to grow their capital, but to make damn sure they don't lose it.
And you really can't start this conversation without this absolute classic from Warren Buffett. It seems so simple, doesn't it? Almost too simple. But trust me, this isn't just a clever one-liner. It is the absolute foundation of a professional, disciplined approach to the markets.
So let's be real for a second. Does Buffett mean you can literally never have a stock go down? I mean, of course not. Even the master himself has taken losses. The true meaning here is way more profound and honestly, way more useful than just a simple command.
What we're really talking about is a mindset. See, Buffett's rule is a psychological anchor. It's about shifting your thinking from a gambler pulling a slot machine lever to a business owner meticulously analyzing a decision. It's not about being perfect, it's all about being prepared.
So here's the bottom line. Never lose money is just a shorthand way of saying, do your homework. Understand that behind every ticker symbol is a living, breathing business. You have to dig in, understand its value, and know what you're buying before you ever click that button. Jumping in on a hot tip or because of FOMO? That is a cardinal sin against rule number 1.
Okay, let's take this from the philosophical to something really, really concrete, and frankly, a little terrifying. Let's talk about retirement, because this is where ignoring rule number 1 can become an absolute catastrophe. This brings us to a nasty little concept called sequence of returns risk. Now, this is a huge deal for anyone who started taking money out of their portfolio, like when you retire. In a nutshell, it means when you get your returns can be just as important, if not more important, than the returns themselves.
Now check this out, because this is where it gets crazy. If you're just accumulating wealth, letting your money grow, the order of returns doesn't really matter in the long run. But look at the right side of this slide. As soon as you start making withdrawals, hitting a bad market right at the beginning is an absolute disaster. Why? Because you're forced to sell more of your shares when prices are low just to get the cash you need. You're literally eating away at your capital base, permanently crippling its ability to ever recover.
And this chart, wow, this just hammers the point home. Get this, all 3 of these scenarios had the exact same average return over 30 years, 5%. But the one that got hit with bad returns early on, it ran out of money. It went to 0. Meanwhile, the portfolio that had good luck at the start ended up with over $750,000. That is sequence of returns risk, and it is brutal.
So that's the nightmare scenario. How do you avoid it? Well, professionals don't just cross their fingers and hope. They operate from a strict, disciplined playbook designed to master risk and keep them in the game no matter what.
Think of these as the non-negotiable rules of the road. First, protecting your capital is job number 1, 2, and 3. Second, position sizing. A pro almost never risks more than 1 or 2% of their entire account on a single trade. This ensures that no single bad idea can blow them up. Third, they always use stop losses. You have to know your exit point before you even get in. And finally, you only take bets where the potential upside is way bigger than the potential downside.
Now, when you put all those rules together, it creates a totally different way of thinking. You see, successful trading isn't about predicting the future. It's about thinking like a casino, focusing on probabilities and just letting your mathematical edge play out over and over again. This quote just nails it. You know, a casino has no idea if the next hand of blackjack is going to be a winner or a loser. And you know what? They don't care. They know that over thousands of hands, their small statistical edge guarantees they'll come out ahead. Professional traders think the exact same way. And the mathematical engine driving this whole casino mindset is something called expected value, or EV. This formula, right here, might be the single most important concept in trading. It tells you, on average, what each trade is worth. If your strategy has a positive EV, then over time you are going to make money. It's that simple.
Let's make this real. Imagine a strategy where you win 60% of the time, and your average win is $300. You lose the other 40% of the time, with an average loss of $200. You run those numbers through the formula, and bam, you get a positive expected value of $100 per trade. This is a license to print money, as long as you can keep executing.
But, and this is a huge but, for that edge to actually work, you have to avoid the gambler's fallacy. That's the voice in your head that says, oh, I've lost 5 in a row, I'm totally due for a win. That is a one-way ticket to blowing up your account. Instead, you have to put your faith in the law of large numbers, which is the statistical proof that over hundreds of trades, your real-world results will eventually match your positive EV.
Okay, this is where it all comes together. This is the climax. Because having a mathematical edge, a positive EV, is completely worthless if you don't survive the inevitable losing streaks long enough for that edge to actually show up.
So the million-dollar question is, how much should you actually risk on a trade? Well, believe it or not, there's a formula for that. It's called the Kelly criterion, and it uses your win rate and reward-to-risk ratio to tell you the mathematically optimal position size to grow your account as fast as possible over the long run.
And look at that, we're right back to Buffett. When he says you can load up when you find a great opportunity, he's basically describing the logic of the Kelly criterion. When you've done your homework and you know you have a huge edge, the math actually says you should bet bigger. But here's the final critical piece of the puzzle, the risk of ruin. This is the cold, hard probability that a streak of bad luck will wipe you out completely before your winning strategy has a chance to pay off. It's the reason why a profitable system can still lead straight to bankruptcy if you're risking too much on each trade.
And if you take away only one thing today, please, let it be this chart. Look at what happens to your risk of ruin as your position size gets bigger. When you risk just 1% per trade, your chance of going broke is basically zero. But if you jump up to risking 20% of your account on a single trade, your risk of ruin skyrockets to almost 6%. That is terrifying. And this is why professionals are absolutely obsessed with small, disciplined bet sizes. It is literally the mathematics of survival.
So I'll leave you with this. Take a hard look at your own approach. Are you acting like a gambler, sitting at the table just hoping to get lucky? Or are you operating like the casino, patiently, systematically, knowing that over the long haul, the odds are stacked in your favor? Because your long-term survival in this game really depends on that answer.